the hidden timing that decides financial winners. Success in finance rarely comes from being right. It comes from being right at the right moment. And most people never see the moment that matters. Timing has always separated winners from everyone else. But today it matters more than ever. Markets move faster, information spreads instantly, and opportunity windows open and close in seconds. What looks like skill on the surface is often precision underneath, an understanding of when to act, when to wait, and when to do nothing at all. To understand why timing now outweighs intelligence, we have to look at how markets actually behave. Prices don't move continuously. They jump. Liquidity doesn't disappear gradually. It vanishes suddenly. Confidence doesn't erode evenly. It breaks at specific moments. These inflection points are rarely announced. They reveal themselves only to those watching closely enough. London became one of the places where the sensitivity to timing evolved naturally, not because the city predicted the future better than others, but because it experienced cycles earlier. Booms, busts, recoveries, panics. Each left behind a lesson about when action mattered most. Over time, these lessons formed an internal clock shared across institutions. At first, timing was learned through loss. Acting too early meant wasted capital. Acting too late meant missed opportunity. Survivors learned to wait through uncertainty and move only when conditions aligned. This patience looked passive to outsiders. Inside the city, it was understood as discipline. As markets grew more complex, time became less about speed and more about readiness. The fastest trader was not the winner. The prepared one was. Institutions learned to position themselves in advance, waiting quietly for alignment. When the moment arrived, execution appeared effortless. But the work had already been done. This created a subtle advantage. Those who understood timing didn't chase trends. They anticipated transitions. They recognized when momentum was real and when it was fragile. They sensed when confidence was forming and when it was about to crack. Most participants never saw these shifts coming because timing doesn't announce itself. It whispers, and only those trained to listen can hear it. Timing reveals itself not in movement, but in hesitation. Markets rarely signal opportunity with clarity. Instead, they reveal it through imbalance. Liquidity pauses for a moment longer than expected. Volatility tightens instead of expanding. Price stops responding to familiar triggers. These micropauses are not accidents. They are the system gathering itself before a shift. London learned to recognize these pauses early. Inside the city, experienced participants watch not what moves, but what doesn't. When expected reactions fail to appear, something has changed. The market is no longer following the old script, and that silence becomes information. This is where timing separates instinct from impulse. Those who act on impulse chase confirmation. Those who understand timing wait for contradiction. They wait for the moment when the crowd hesitates, when confidence fractures unevenly, when participation thins without explanation. These moments feel uncomfortable. They resist certainty, but they are where outcomes are decided. As technology accelerated, the sensitivity deepened. Algorithms began detecting timing asymmetries humans could barely perceive. Entry and exit points narrowed. Opportunity windows shrank. Acting a second too early or too late erased advantage completely. Timing became a discipline of restraint rather than reaction. Inside the city, preparation replaced prediction. Institutions positioned themselves quietly, building optionality instead of conviction. They accepted uncertainty in exchange for flexibility. When the moment arrived, they didn't rush. They moved with precision. This discipline was learned through repetition. Markets punished impatience ruthlessly. Acting early meant absorbing unnecessary risk. Acting late meant paying a premium. Survivors learned to wait until the market itself invited action, not loudly, but subtly. But this discipline created tension, because waiting feels like weakness. Silence feels like indecision. Inaction feels like failure. Yet the most decisive moves often begin with stillness. And the hardest part of timing is trusting that stillness when everyone else feels compelled to move. The conflict appears when patience collides with pressure. As markets accelerate, the demand to act becomes overwhelming. Screens flash, prices jump, Commentary intensifies. Everyone appears to be moving, and standing still begins to feel dangerous. This is where time becomes most difficult. Not because the opportunity is unclear, but because resisting momentum requires conviction. London experiences this tension constantly. The city sits where global flows intersect, where every signal arrives amplified. Pressure builds not only from markets, but from clients, competitors, and internal expectations. Acting too late risks irrelevance. Acting too early risks exposure. The margin for error tightens until timing becomes the only edge left. This is when mistakes are made. Participants confuse activity with insight, movement with meaning, speed with advantage. They chase momentum that has already exhausted itself. They enter positions when risk is peaking, not forming. The market rewards them briefly, then reverses without warning. Inside the city, veterans recognize this pattern instantly. The most dangerous moments are not when markets are calm, but when they feel urgent. Urgency compresses judgment. It narrows perspective. It tricks participants into believing that delay equals loss. But timing demands the opposite response. When pressure peaks, patience becomes power. Institutions pull back slightly. They reduce exposure instead of increasing it. They wait for confirmation not in price, but in behavior. They watch participation thin. They watch confidence wobble. They wait for the moment when movement no longer feels crowded. This creates an uncomfortable asymmetry. Those who wait appear wrong until they aren't. And when the shift finally arrives, it arrives violently. Liquidity vanishes. Direction reverses. The market punishes late entries mercilessly. This is the emotional cost of timing. It requires standing alone while others move. It requires enduring doubt while others celebrate. It requires accepting temporary underperformance in exchange for long-term survival. Not everyone can tolerate this, and that is why timing remains one of the rarest skills in finance. The climax arrives the moment the crowd finally hesitates. Momentum fades, volume thins, and the certainty that once felt unbreakable begins to crack. This is when timing reveals itself fully, not as speed, but as alignment. Those who waited recognize the shift instantly. The market no longer moves because it should, but because it must. Pressure has built unevenly. Confidence is fragile, and the next move will not be gradual. London's advantage is not foresight, it is recognition. Institutions that master timing do not rush this moment. They act cleanly, decisively, without hesitation. Their moves appear sudden to outsiders, but they were prepared long before. What looks like intuition is the result of discipline. What looks like luck is the reward for restraint. This resolution reshapes outcomes. The winners are not those who predicted direction first. They are those who waited longest without losing clarity. After the shift, narratives form quickly. Explanations appear. Models are rewritten. Everyone claims understanding. But timing has already done its work. Capital has moved. Risk has been transferred. Opportunity has closed. The lesson is simple, but unforgiving. Markets reward readiness, not urgency. They punish haste disguised as confidence. And they remember who waited when waiting was hardest. In a world obsessed with speed, timing remains a quiet advantage that cannot be automated, imitated, or rushed. Sometimes the smallest shift in perspective becomes the beginning of a new future.